Okay, welcome back to Rockstock Channel. It is Monday, January 22nd, and we have back on the program our great friends at Fastmarkets, Will Adams and Jordan Roberts. We had you, Will, alone here in October. We're going to play back some of your musings back then.
We think, now because we're starting to see those cutbacks, we think the price falls will start to level out now. If anything, we're expecting a bit of a rebound into the final months of the year.
Will, what is your long-term price assumption?
So yeah, we think prices for the, as I say, to the short term, we think we're moving higher again. The 25, 35 sort of dollar per kilogram is a sort of a comfortable range to be oscillating around.
Before we start today's video, we'd like to thank Lithium Royalty Corp, listed on the Toronto Stock Exchange, ticker symbol LIRC. We'll share more later in the video. We thought we had a bit of a market bottom and would recover, but prices accelerated downward, since then, and we're going to discuss that here. But before we get into that, just want to highlight the Fastmarkets flagship conference, and it will be again in Las Vegas. It's June 24th to the 27th. So it had record attendance last year, which we all should have taken as a overly bullish sign. But nevertheless, we live in interesting times, is both a blessing and a curse, according to a Chinese proverb. And these markets have turned very fast negatively in 9 months, and 6 months from now, they could change very significantly in a positive direction. But overnight, I want to start with this. Liontown announced that their debt package will need to be refinanced, right? So just 3 months ago, they had agreed a package after Albemarle had left the deal. And the reason that they gave for having to refinance on a smaller package was actually due to a price reporting agency that they had agreed with their financiers, their syndicate of lenders, basically said, we're going to lend to you against what Woodmac, the former Roskill, forecasts for lithium, spodumene prices in particular. And 3 months ago, when they negotiated the deal, there was one price. And now, last Friday, it arrived on Liontown's desk, the new Woodmac report, which said spodumene prices in 2027, 28, and 29 would be $950 CIF. China. And as a result of that, the lenders were not willing to lend as much. And Tony at Liontown said that those were very aggressively low, in his opinion. Rodney and I kind of agree with that. I spoke with Jordan. Why don't you tell me what you sent overnight are your forecasts for 27, 28, 29, as well as, in the nearer term. And as a result of core and this Liontown news, what impact this might have on your forecasts.
Yeah, absolutely. Yeah, our forecast for 2027 is actually $1,600 a ton. $650 a ton higher than the price used in the Liontown funding. We then see it slightly coming off in 2028 and 2029 to around $1,250 a ton and $1,300 a ton. I think at least in the near term, we have this year averaging $1,200 a ton and next year $1,100 a ton. But like you said, based on the recent announcements, this forecast was done in November. Since then, we've had the announcement from Core. We've also heard of some cost implications for African producers, such as Arcadia, which they're currently making a loss apparently and looking to offload staff. In our next forecast, I definitely think there's scope to increase the price forecast for this year and next year based on the lower spodumene production.
When are you going to are you going to wait for the quarterly results to come out from the spodumene producers before you come up with that new forecast? Because Pilbara and Midres are coming out this week.
Yes, yeah. The Q1 update will be out at the end of February.
Okay. So just bear this in mind. Any lithium executive or issuer, or just like, in my opinion, I'm just like shocked that such a large financing package that Liontown negotiated with a syndicate was based on one data point from one provider. And that provider, Woodmac Roskill, basically downgraded their price 60%, but had Fastmarkets numbers, the numbers you just articulated, been in the mix. If they said, oh, we're going to use a blend of Woodmac and Fastmarkets price, then maybe although you didn't update your price, last Friday as they did, maybe they wouldn't have had to reduce that package. So very interesting how powerful price reporting agencies actually can be in influencing, markets here. And one would think maybe, why don't you take a blend of not only Fastmarkets and Woodmac, but benchmark, CRU. It's very interesting how these dynamics play themselves out. But okay, so Will, you published a good note late last week, which we've seen has gotten good traction on LinkedIn and Twitter. And you're talking about, inventories generally. I want to compare, I want you to discuss that, but also, Albemarle in their November presentation was also talking about, inventories being low at the cathode level, at the converter level. And we still haven't seen, we thought the destocking would happen aggressively then. It hasn't happened. So please explain your note and your thoughts for the start of the year.
Yeah, so we're tracking stock in the across the value chain in China, and we are seeing stocks coming down, trending down now, quite smartly. We're seeing certainly a big reduction in stocks in the cathode active materials manufacturers, and that's one of the areas where we think we need to see that destock, which then will see orders start to work back up the supply chain again once the market has destocked more. I think it's what we see in these price swings, whether it's on the upside or the downside, so much has to do with whether the market is in restocking or destocking mode. And we've just been in a very aggressive destocking mode. And I think, that really goes all the way back to, you can trace it back to, the run up in price we saw in 21, 22, which went to actually, extreme levels with some of the lithium carbonate prices up like over 1,400%. I think that created a huge pain threshold for people, which forced them to destock. And then as soon as you start seeing prices falling, then, that just encourages more destocking, especially in a market where, it's been, you can't really hedge. You can hedge now, but, that's actually started to come on. It's come on in China and it's come on in the US to some extent.
So what has happened in the last 3 months? In October, again, you came on here and you thought, the destocking was largely ended, but it's only accelerated since then. So what's going on?
Yeah, so we haven't seen as much cutbacks as we thought we probably would have seen, mainly in the lepidolite operations in China. I think because you've had the GFEX exchange in China, that has created the ability for Chinese producers, not just producers, Chinese producers, but also those holding stock to be able to start hedge selling. So that's added to the downward price momentum. That's slightly weaker than expected demand. And certainly the fourth quarter of the year tends to be a strong period for demand. Historically, we didn't see that this year.
Okay, but the demand starts like from the cathode level. When you say demand, right? So the cathode, if the cathode makers, which are operating at very low days of inventory, are not buying, that's because they're not seeing their battery and EV customers, 6 months from now, buying or selling vehicles.
Yeah, but they also, if you look at that chart, that where the big buildup of inventory was at the CAM manufacturers. So they've got the inventory, they can destock longer, and that's created a weaker than expected demand.
But I thought
think
those
the
guys in November, according to Albemarle, were on single days inventory.
Yeah, we heard similar things, but we're looking at the data. It doesn't seem to be that case.
I would also probably add that you know, consumption levels, although EV demand has been, seriously strong, December was a bumper month. There's a bit of an overhang of battery inventory, which means that increased EV sales can't be effectively transmitted upstream. So until the battery inventory is down to slightly lower levels, they're not going to have incentive to order more CAM material, and therefore more CAM people are quite happy running off long-term contracts at the moment. They're supplying their volumes they need and have no need to delve into the spot market yet.
So that's just on that, Jordan, that's a highly contested, depending on who you speak to, as to where battery cell inventories are. Was one of the things I wanted to raise as well. We're hearing talk of LFP cell prices going under $50 this year, which I would think, that would put profitability back to the EV makers. So that would be an incentive to push volume. Where do you see, the cell inventories, and what do you think is a reasonable inventory level to carry in months for the cell guys, and for, downstream from them, how many EVs should one really have on the showroom floor? How much time?
Yeah, I think generally I'd say like sort of 2 months is probably what it has been. Depends on what part of the cost, the supply chain you're looking at. But I think if you're further sort of midstream and you're relying on longer supply chains, then, given all the sort of disruptions we've seen, we saw it initially after COVID. We then saw it with the Suez Canal when that was blocked. We've seen it with, in other areas. There are more and more disruptions. And now obviously we saw it with the Ukraine war, and more recently with the sort of the Red Sea and the shipping container. So I think given all these, we're seeing more and more sort of big disruptions. I think people are probably, I would be more comfortable holding like three months worth of stock. But again, it's not just about the comfort level. There are other aspects of it. So you don't want to be holding a lot of stock if prices are falling and you can't hedge it. There's a cash flow of tying up inventory as well, depending on interest rates and cost of money. So all those factors need to be taken into account as well. So it's a sort of I think, on average, if people in good conditions, then, between 2 and 3 months worth of stock would be ideal, but it will vary around that depending on the market conditions and trade conditions.
I think.
And then where would you say we are now?
In China, I'd say we're generally about 3.5 months probably.
So not far off that upper end.
No, but I'd also say that in China, probably because so much of the processing and so much of the availability is in China, then they might well feel more comfortable with carrying less inventory.
Yeah, I mean, I would say on cell cost, our cost index, which is put together by Krishna Mutu, he for December has the LFP average cell cost at $74.3 per kilowatt hour. That's based on a 1 gigawatt hour per year operation. So obviously there's going to be lower prices when you take into account scale. But that is 4.1% down month on month and 37.4% down year on year. So yeah,
so we're not quite thinking we're at that $50 level yet.
No, I'm saying later on in the year. That's what I'm hearing. So yeah. if you convert to where prices were a year ago, that's quite a big saving on a 60 kilowatt hour battery pack.
Yeah, and anything that goes in to make EVs cheaper and get some sort of closer to the comparable cost of an ICE vehicle, is all going to be good news. But there are obviously other considerations as well. Some people are not ready for EVs yet. Some people, the infrastructure, charging infrastructure isn't there. So I think there's so many other sort of factors that sort of need to slot into place to really, so you can just say, lower prices is going to, encourage everybody to move towards EVs. There are a lot of other factors there, but, And that, again, depends on where you are in the world.
Jumping in here from the editing room to tell you about Lithium Royalty Corp. Lithium Royalty Corp is at the center of a global energy transition and manages a globally diversified portfolio of lithium-focused royalties in electrification and decarbonization. With 32 royalties on 29 higher-grade, lower-cost projects from exploration to production, LIRC covers all the bases with well-managed risk, ESG considerations, and a scalable royalty structure. Lithium Royalty Corp is traded on the Toronto Stock Exchange, ticker symbol LIRC. To find out more, visit lithiumroyaltycorp.com.
Guys, one of the things I wanted to touch on was where Europe and the US is in terms of onshoring or reshoring or setting up independent supply chains. How do you think, progress is happening in those jurisdictions? And, what are your thoughts going forward the next few years? Can US and Europe fill all the gaps on cell, cathode, and raw materials?
I think the short answer is no, they can't. I think there's a lot of catching up to do. Jordan, do you want to go into a bit more detail?
I don't think we're anywhere near it. There's been a few announcements, but on the other hand, there's also been some worrying news, especially the deferred investment in the Megaflex facility by Albemarle in the US. But they're still providing capex for the Chinese and Australian facilities. And I think in the current price environment, you are likely to see financing become more difficult to come by. But considering the investment from the US government, and the build out of the domestic supply chain, including these generous incentives, to the decision to defer the Megaflex conversion facility has come at a bit of a surprise. Because based on the demand projections, there will be still a significant lack of domestic refined supply in the US.
Yeah. So I think even if Europe and US companies are relying on getting their batteries from Korea or Japan, there's still a lot of that material. The ingredients of that material will still be being processed in China. So it's very hard to see in the short term too much independence from China. In time, yes, but it'll take time.
And on that note, I noticed that that the number of IRA compliant vehicles in the US is quite low, actually. Is that going to stay the same?
Yeah, so we have seen that. It'll take time before more US made vehicles are IRA compliant. But I think it's a big order to try and break away from China in such a relatively short period of time, considering how long it can take to build up domestic supply chains.
And just sticking with that theme, I'm sure you would have noticed the chart that China became the largest exporter of vehicles last year. It overtook Japan and others. So an eye-watering number, and really in short order, with about 1 million EVs. And my models, if you look at the ramp up of EV production in China, I'm expecting a big number on exports again this year, probably even a doubling. So it looks like the rest of world category outside of the US and Europe is going to go, to Chinese, manufacturers that have a substantial and decent offering in very low price points, which makes sense in Africa where I am and elsewhere. Do you guys, see that, and how are OEMs even possibly going to compete with that when these guys are making tons of sub $20,000 models?
Yeah, we're seeing it. We do see that. Even in the UK, there are a lot of Chinese-made EVs around now. It's been noticeable, I'd say, in the last year or so, how many more there are. I suppose it comes down to whether the US or whether EU countries start to either have import taxes or whether they go on to sort of carbon border taxes and things like that to try and level the playing field.
Yeah, it'll be interesting if what you're saying is the components in the battery are still Chinese made. What's the difference?
Yes, but it'll come down to that sort of carbon, whether there is a carbon border tax.
But rest of worlds where it's outside of Europe and outside of the US, that's fair game.
Yes, and I think that we've seen over the last year or whatever, there's been a lot of call. Well, China is just making so much capacity, far too much for their own need. But maybe that's their aim is, after decades and decades of playing second fiddle for cars from the US or from North America or from Europe, they've got this lead in the EV space, and they're looking now to hold that lead and to really become the supplier of EVs to the rest of the world. So I think that takes that we should expect, and we've seen it in so many different things. We've seen it in other commodities as well. China has this capacity to just build loads of capacity, far more than is necessarily needed. That's one of the reasons why we're also seeing these sort of low lithium prices as well. But it doesn't have to stop at the commodity level; it can happen at the industrial level as well.
And just broadly, in terms of the broader demand thesis, have you changed? Was Fastmarkets adjusted or lowered or increased your EV penetration rates and your sort of expectation on EV sales going out to say 2030?
I think they've remained fairly level over the last few months. I think there's been a slight uptick in plug-in hybrid vehicles. We're seeing stronger growth in hybrid electric vehicles in China. We're also seeing they're performing quite strong across the US as well. So I believe over 50% of all the Ford Mavericks sold in the US with a hybrid powertrain. They sold a significant amount of F-150 hybrids, as well as an over 50% increase in F-150 full electric sales. So I think hybrids will be an important component of sales in the US. And going back into the rest of the world, I don't think there's any brand loyalty in Southeast Asian countries. They'll take the best car that they can probably get for their money. And also, if we look at Europe, there's forecast to be about 1 million less people in the middle class by 2030, whereas the developing countries in Southeast Asia, that's where the growing middle class is. And those are the people that typically buy vehicles more regularly, upgrade their vehicles. So I think Southeast Asia, Thailand, Cambodia, Indonesia are going to be important sales regions for EVs going forwards.
So broadly speaking, there might be an adjustment on gigawatt hours between full battery electric and plug-in hybrid, but the penetration and total volumes are largely unchanged.
Absolutely. And there was a recent survey in the UK. It was a small survey, just a couple thousand people, but 92% of current EV owners said they wouldn't move back to an ICE vehicle. For me, that's a positive.
The hybrid question you mentioned has come up with the IRA guidance. There's, they categorize a lot of plug-in hybrids to get the $7,500 credit and maybe less full EVs. And I saw some chatter on Twitter about that might save the incumbents bacon rather than them going bankrupt over the next kind of couple of years. And they lobby hard for that. But I want to go back, Will. We have maybe 5 or 10 more minutes to your comment, which you just made earlier, and you've made it multiple times before in our interviews with you. Is never underestimate the Chinese and their innovativeness and their ability to respond. There is a narrative that I would love to believe, which is the iron ore analogy that Ken Rinsden articulated in our interview recently, Dale Henderson, which is that, China does sometimes subsidize high grade or high cost magnetite, and that just caused, the cost curve to be higher. And the parallel is if they're subsidizing high cost lepidolite now to some degree, or I don't know if China's subsidizing it or if CATL is going to operate at a loss, just so that they have this alternative supply. But the thought process is that the cost curve will just be higher. Therefore, if you're lower cost, like the low cost iron ore producers,
you're going to generate these software margins at the mine level. But there are many other instances in China where that's not the case. So in nickel, we thought nickel was going to be a big problem, but you had the nickel pig iron, I don't know, 5 or 10 years ago, and most recently with HPAL working, but there are other examples of what they've done to, solar panels, copper. So to make this iron ore analogy again, I'd like to believe it. And I think there is some merit to the iron ore analogy, but it's anomalous to other analogies where, whether it be steel, whether it be aluminum, copper, all these markets are commodities, and yeah, it'll be cyclical. The miners will make big money in periods of time, but then it'll be a bust. It's like oil. So in your opinion, is lithium like iron ore, or is lithium going to go, or is spodumene like iron ore? Or is lithium going to go the route of all of these other examples, where it's just commoditized and it's a tough market?
Yeah. I think I would say it's probably just building over capacity, less control. And as a result of that, prices remain under pressure. I think that's happened more now because it's still a relatively small market in a strong growth area. I think it'll have less of an impact later on as the whole market gets that much bigger, and we need to get more resources from outside of China or outside of China plus China's partners, and therefore that will lift the cost anyway. But maybe one reason why sort of the likes of CATL are saying they'll run their operations at a loss is, if you go back to the thing that, lithium is a specialty chemical, and we all know that if you're making lithium carbonate or certainly lithium hydroxide or batteries, you want a consistent supply. So maybe that's why they're prepared to run their operations at a loss. They've got their cathode sort of manufacturing process tuned into that type of material, and therefore they want to continue down that road, if that makes sense.
Just on that, if I can jump in there, prices are low. We briefly discussed where the cost per kilowatt hour could get to on LFP. Where does this leave sodium ion? Because to my mind, if LFP goes under 50, sodium ion got no future.
I think, Jordan, you might have something to say on that, but I think just one thing is, I think generally you'll have different battery chemistries will suit different applications. So sodium ion has a higher safety record, so that might be applicable for certain types of lithium-ion batteries, where certain types of batteries where the lithium-ion batteries might not be so applicable. But on the cost thing, Jordan?
For our next update due the end of February, we've actually dropped our sodium-ion battery penetration in EVs from 9% in 2033 to 5%, with just a 3% penetration of sodium ion in EVs in China, which you would think would be the global leader of it as well. We've actually kept it the same in ESS. So that points to, what Will was saying about application. But certainly EVs, I think at these sort of prices, there's just no need for it. We're actually seeing more upgrades to LMFP and slight downgrades to NCM 811, just because the price of cobalt and nickel is so low at the moment that actually on a cost basis, it doesn't make sense to reduce or thrift those metals. And 622 is perfectly fine for most people's ranges, and it's inherently safer. So we're seeing a slower transfer over to 811 in the long term.
Just on the sodium ion, up to what lithium price on a cost performance basis, let's say in EVs, is it still in favor of LFP or LMFP?
We haven't actually crunched those numbers, but if we do, we'll be right in touch.
Yeah, I think on that, if you've got if you've got NFP battery prices coming down, you're going to, you've got companies who are investing in sodium ion. Their costs are also likely to come down as well. So I think that's something to bear in mind. But I think sodium ions came along really as a result of the high cost of either NCM or lithium and the other battery raw materials. I think there is that price, if we do have no commodity prices for longer, then I think there is less need for that sodium ion, and there probably will be less sort of investment going into that area. But it is, sodium ion batteries are out, they are there, they are being used. So I think that will, it will remain a technology for batteries for part of the market.
So Will, just to, I know we have only a few more minutes, but look, we've been speaking, Rodney and I, we're having 4 or 5 meetings a day now in day 11, and just putting together, you're piecing together a mosaic of what's happening, speaking to developers, producers, sell side analysts, and the like. And there's a number of projects out there which are having strategic processes, attracting Western OEMs, Chinese, and the like. And it seems like the Western OEMs and Asian or ex-China OEMs are maybe pulling back a little bit, but the Chinese are becoming more aggressive in their approaches. And we saw like Atlas signed a deal with the two Chinese groups late last year, which seemed to remind me of like 2016, 2017, Western Australian spodumene deals. So there are some conspiracy theorists out there who have basically been arguing that, the Chinese are manipulating the market. They didn't like that if you own your own rock, you're God, and all the margins were going to the miners. And now big China has come back in force here and is manipulating the market so that they could acquire assets on the cheap right now. How true do you think that is? And you mentioned the GFEX, which started in July and around the time, the prices have come down. Do you subscribe to this conspiracy theorist, argument, or is it, are there more fundamental things at play here? Is just like, proper investment, and you could turn on the lepidolite mines a lot faster than you can integrated mines, outside of China.
Yeah, I'm not such a fan of the conspiracy theory. I do think it is more of a factor of the fundamentals, in that we've had more suppliers come in a short period of time. Again, we saw it in 2017, 2018. We've had another sort of run of that. And we're now really waiting for a combination of, demand to pick up, but also some more supply restraint. And I think we'll see both of those. I think what happens is that when you have this low price environment, and if Western companies do struggle, if they're struggling to get finance, or they, taking longer delays, then I think China, will step in and take advantage of that. I'm not necessarily saying they've engineered it for that. It might just be, it's happened, so we will take advantage of it.
Okay. It's going to be a much tougher financing environment. The equity prices are quite low. Debtors are pulling, from Liontown. So Western OEMs, I think, are reluctant to finance in the way that they were this time last year. So the Chinese would be, great, if you want to advance your project, and they're able to. In some places, they're not able to, like in America and Canada. But in Argentina and Brazil and Africa, projects there, I would expect to see, funding from the Chinese to accelerate. But your forecasts, even though they're more optimistic than Wood Mackenzie's extremely bearish ones, Jordan, even in the, 1,200, 1,300, even 1,400 spodumene from here until 2029 are exceptionally, bearish numbers. I think, Rodney, you think, we need like 2,000, to incentivize, projects. So at the prices you're forecasting, do you see any, projects that were cut, their feasibility studies were cut at, much higher prices? It's just not, they can't get done. Right. So what happens? You think you're going to push those, you'll get the supply cuts to push up those forecasts, or what do you think?
I think so, potentially. And if we look just a bit further out than 2029, like we have our spodumene prices going significantly over $2,000 a ton because, we see a supply gap opening then. So I don't think these low prices are forever. I also think we have a widening of the cost curve. We've got several brine assets ramping up that tend to be lower cost anyway. So the need for that higher cost supply gets pushed out of the cost curve after the fourth quartile. You're going to have high grade quality assets like Mount Holland ramping up, which should be a fairly low cost producer of spodumene units, and obviously that's going to be integrated. Having said that, if we start having projects, such as your Goulaminas large scale project in Africa, maybe other projects in North America, your James Bays, or certainly some of the projects in Brazil being pushed back or just cut altogether, then certainly there's scope for an increase in spodumene prices. And I think, will we reach the highs where you start incentivizing DSO as well? Potentially at some points. Sure, the price it's volatile, it's inherently volatile. We expect that to continue. But I remember Global Lithium saying you could probably generate value from DSO at about $2,500 a ton on an SC6. So I would say that would be the minimum price to incentivize kind of DSO shipments.
But DSO, as Rodney said, is the canary in the coal mine. If we're getting there, then the price is too high. You shouldn't be shipping DSO. Like DSO should not be a product. Pilbara wants to move like downstream into, some higher value added. That makes no sense in that sense. But do you have any insight as to whether or not Goulamina, is going to be, Ganfeng just increase their stake in that? We understand that to be, going forward with no problem.
That's our understanding as well.
Okay.
Same for
James Bay and Nemaska. That's like a decisions we'll be listening closely to from Arcadium perspective. But we understand Nemaska's under construction. Mount Holland's under construction. Kathleen Valley's under construction. So these things are going ahead, and lithium will be needed. You say 2029, you have deficits after that, but that's like miles away. That's 6 years from now, right? Like a Ford, a GM, LG, SK, when they're negotiating with a I don't think any project that currently has a project on the cards is going to, take too much faith in a 2030, price number. There's going to have to be some meeting of the minds. Otherwise those greenfield projects just won't get funded. The peak pessimism, as we mentioned last video a few days ago with a question mark, has, we're not at peak pessimism because you see, Liontown, a penny stock once again. But thank you very much. Your note is somewhat, optimistic, Will, that yes, we will get to a point, where the destocking happens, stops happening and the buying starts again. And, in Albemarle we trust, or Albemarle to the rescue. Let's go see what they're going to do at Greenbushes and Wodgina. So looking forward to seeing those quarterly results. Thanks again, Jordan and Will. And for all our viewers, make note again of the June 24th to June 27th Fastmarkets conference in Las Vegas. Rodney and I will hope to see you there.
Thank you.
Thank you.